VP of Programming. And it's very nice to have you all joining us. So thank you very much. Today we have a collaborative alpha using AI to combine the best of human and machine. And we have two wonderful individuals from our Diamond sponsor, Voya Investment Management. Before I introduce them and get into our meeting, let me go over some of the upcoming events that we have coming up for CFA Atlanta. As you know, in 2 weeks, we're going to have our annual forecasting event at the aquarium. We're having Kevin Warsh come and join us. That will be February 6th, again, at the Georgia Aquarium. We're expecting upwards of about 500 people. So that's going to be a wonderful evening. And we're looking forward to Mr. Warsh. A few weeks after that, February 21st, we will hear from the CEO of Neuberger Berman for lunch at the Buckhead Club. And also at the end of February, on the 24th, we will have the Research Challenge Finals at Kennesaw State. So if you want to join us on the morning, Saturday morning, February 24th, and watch the 5 competing teams for the Research Challenge, please join us for that. And with that, let me introduce our 2 speakers today. First, we have Mr. Vincent Costa. He is the Chief Investment Officer for Equities at Voya. He's also the Portfolio Manager for the Active Quantitative and Fundamental Large Cap Value Strategies. Before joining Voya, he worked in managing the quantitative equity investments for Merrill Lynch, and he has an MBA in finance from the Stern School at the New York University, as well as a business analysis degree from Pennsylvania State University. Chrissy Bargeron is a client portfolio manager for the equity investment platform, supporting the quantitative equity businesses. Prior to Voya, she served as the vice president of the product management team at Research Affiliate, and she's also worked in smart beta equities and manager research at Willis Towers. She studied her Master's of Science at the London Business School and her undergrad in finance from the University of Delaware. And both Chrissy and Vincent are CFA Charterholders. So we're very excited to hear from you. If you have any questions for them throughout the webinar, please type them into the chat. And towards the end, we will begin going through your Q&A. And with that, I'll turn it over to you, Chrissy, and thank you very much for joining us.
Great, thank you, Hunter. I'm going to share my screen here for everyone. I think you should all see that now. First, just thank you all for taking time out of your busy lunch breaks to join us today. Vinnie and I are thrilled to be here and ready to dive into a discussion about the integration of AI and machine learning into the investment decision-making process. As we go further into 2024, it is incredible to really reflect on the journey that we've had since the launch of ChatGPT over a year ago. Today, AI is not just a buzzword anymore. We think it's really an integral part of our present reality. In the asset management industry, what we'll discuss today is that we don't think AI is just a nice to have right now. We think it's an essential component to what we do. And the potential and possibilities that it brings are truly remarkable. But before we dive into that potential, we wanted to start with a poll to gain some insights on how you are all using AI today. So I'm going to pull that up here. And I think I have my poll. I apologize, but I think my poll capabilities are down. But we did just want to kind of get an understanding of how you're using AI. Oh, there we go. I think you guys should see it now. 2 questions here. First, are you using ChatGPT in your personal life? And then second, in your professional lives, how are your firms using AI or machine learning? We have a couple of options for you to enhance operational efficiencies as part of the investment decision-making process like we'll discuss today. to improve your distribution capabilities or customer experience, perhaps not at all, or all of the above. And I would say for simplicity, if you're using more than one of the first three options, you can use all of the above. And I would just give people a couple seconds here. I think we have most of this is answered. Gonna end the poll and share the results. And so in personal life, we have about 3/4, 76%, yes, are using ChatGPT. I would add myself to that list. I use it almost on a daily basis in my personal life. It's fantastic. Professionally, and surprisingly, I think we're still early to adopting this in our industry. Kind of mix, about 11% of you are using it in the investment decision-making process. Outside of that, it seems to be the most popular option is to enhance operational efficiencies, and 40% not at all. So, very interesting in the personal versus professional. When we think about this throughout today, I hope that you come away with some interesting ideas for how you can start using AI. And if we did this poll a year from now, I'd expect these numbers to increase. With that, I'm going to pass it off to Vinnie.
Great. Thanks, Chrissy, and welcome everybody. Great to have so many of you join the call today. Before we dive into AI, I thought it would be helpful to give a kind of a quick high-level history refresher, if you will, on active equity investing and how it's evolved over time. So we really started from the first wave, what we kind of think of as the first wave, which is fundamental investing, right? So here's where kind of it began. We kind of take the lessons of expert investors, the Graham and Dodds, Warren Buffett, Peter Lynch, many of the great stock pickers, which still resonate today. So fundamental investors typically target individual stocks, going pretty deep inside each company to form a holistic view on that company. Sort of a mosaic theory where you research all publicly available data and information to make predictions about future stock performance. And out of that, you can build a relatively high conviction portfolio with relatively low turnover. So I think that's where most of the active equity space lived until probably the early 90s, where we started to hit the second wave, traditional kind of quant investing. It's about the time I got involved in the business. Over time, as technology evolved, quantitative investing really emerged as a key investment strategy. And quant investors really target factors, and they build linear models that are generally coded by computer science experts and programmers. But using a systematic approach has some real advantages to fundamental, right? You could cover a broad number of stocks, you remove investment emotion from investing, and you do it at a relatively lower cost. But the flip side of that is you're building a relatively low conviction portfolio with a relatively high turnover. Just a note, as Hunter sort of introduced me, I spent most of my career as a quant investor, and I can tell you that although it's fairly status quo and today and a pretty well accepted approach to investing, it was not always that way, and much the same as we see with AI and machine learning, which kind of brings us to our third wave, which is machine learning. I think we're firmly in that wave right now. There's certainly been some early adopters that have been out there for a long time, but I think it's becoming a lot more common. As the poll showed, we've got more people using machine learning in their process. But similar to the early days of quant, there's a lot of confusion about the benefits of AI and best practices. So we're hoping today we can shed some light on that. But when it comes to investing at a high level, machine learning is really able to combine really the best of the first two waves, fundamental and quant, because it's targeting stocks. It's able to go deeper into companies than a traditional quant model, while still covering a very broad array of names using more nonlinear models and pattern recognition technology. So that's really kind of the third wave of it. And when you put it all together, what we think is that the future of investment really lies in the ability to put those together, really integrate human expertise with machine intelligence using a very collaborative approach, which we'll get into today. So that's kind of the quick history refresher, but it kind of begs the question, how do we combine the strengths of humans and machines to avoid, their weaknesses, and how do we become better portfolio managers and deliver more alpha for our clients? And that's what we're gonna work towards today. So when it comes to investing, I think Chrissy said this in our intro, but we'll say it a lot today. We think it makes sense to utilize the strengths of both human and machines as much as possible, sort of a co-pilot model. For example, on the human side, human expertise, we think it should be utilized to challenge conventional thinking. And in a fundamental investment process, that means gathering information from company management, means doing channel checks, forming a buy-sell thesis on a stock. But when it comes to leveraging the machine side, it's really all about being able to process a massive amount of data and training models to find profitable patterns. And then you synthesize that into key information that can either support or disprove a thesis. So by blending the two together in a very collaborative way, we think we can generate much better stock ideas, make better portfolio decisions, and ultimately deliver more uncorrelated alpha for our clients. And listen, organizations are doing this all the time, right? What's referred to in the in the industry now, this collaborative intelligence concept, it's growing and it's all a part of our lives, right? You think about virtual assistants like Alexa, like Siri, like Cortana, where humans have trained machines to assist in day-to-day activities. They even have different personalities to reflect their individual brands, whether it's Amazon, Apple, or Microsoft, because they were trained by humans. And there's other situations where you've got machines assisting humans, and a good example of that would be credit card fraud, right? Banks and credit card companies all have unique ways of applying the technology, but they all use AI, some form of AI-based solution to apply it and to improve the speed and accuracy of fraud detection. You only have seconds to determine if a transaction should be approved or not. So to be clear, the goal here is not to displace workers. It's to collaborate in a way that transforms the workforce and the organization. So with that backdrop, I'm going to turn it over to Chrissy to walk through how we think about the next step, which is turning collaborative intelligence into collaborative alpha in the investment world. Chrissy?
Great, thanks, Vinnie. I hope some of this resonated with all of you and you're familiar that in your everyday lives, you are using collaborative intelligence. But for collaborative alpha, how do we actually apply this to our daily jobs as investors? First, I think it's important that we define what our goals are. And so as an investor or a portfolio manager, we want to maximize our skill. And to do that, we want to leverage our expertise and we want to minimize error. And errors in our industry today can be defined as bias and noise. And so how do we do this? We, as Vinnie just went through kind of the history here, we have two very powerful tools at our disposal. One is our human brains and our domain expertise. And we want to maximize this and then leverage these AI tools to help minimize those errors. When it comes to AI, there's a number of different areas that we can dive into. This can include expert systems, deep pattern matching, NLP, amongst others. But the key to maximizing this skill and minimizing this error is to effectively combine these two. And unfortunately, it's not just as easy as dumping data into a magic algo. Just like with collaborative intelligence, it requires a harmonious blend of human-assisted machine processes and machine-assisted human approaches. And so to determine this optimal combination, there's a number of questions that we need to ask before we even start. These can include, what is our ultimate goal? What's the sequence of decisions that we're making? What is our data? What is its value? How much data do we have? All of these considerations can help to guide you to finding that right balance. So that's what we're going to do here. Just for a starting point, we have a quote from Garry Kasparov. He was the chess grandmaster that IBM's supercomputer Watson famously beat. And he said, weak human plus machine plus better process is superior to strong computer alone. And so defining that better process is going to be what's vital to be successful in investing and using AI to invest. And that's because we actually have a number of hurdles in our industry. First is the data. Everybody likes to talk about data, and it's extremely important. But in finance, we don't think that we actually have big data or Google scale data. We actually have small to medium data. I will note there's one exception there, and that's in high frequency trading, where you have nanoseconds of data. You can use more deep learning models there. But in investing in public equities and long only investing, where we're taking a longer outlook, we have small to medium data. Arguably, you could say we have about 18,000 data points per company that span a 20-year period. And then depending on the region, that data is going to get more scarce. And then in addition to that, the data that we have has what is known as a low signal to noise ratio. And so that means that the data can be noisy, potentially irrelevant. So out of those 18,000 data points, maybe 10,000 are material. And so this goes back to what I noted before. We can't just dump it and expect a magic algo to give us accurate results. And so the benefit here actually comes from the human. So to help overcome this challenge, we can leverage those investors like ourselves that have a domain expertise here. They play a crucial role in scrubbing the data, refining it, standardizing it across data sets, and then training the models on what is known as a feature. This is a machine learning term that the humans will feature engineer the data points for materiality. To keep it a little high level, the technical definition of feature engineering is the extraction and transformation of variables from raw data. So this is less exciting. It's not the most sexy part of the process, but it's probably the most important. And when the humans here are feature engineering, they are essentially providing the models with the CFA or a textbook-like resource to learn from. So helping to tell them what's material. And so a question we get asked when we talk about the data here is, well, how do you know if a manager or an investor is using these AI resources in an effective manner? How do you test the ability to feature engineer? And I want to remind you of the 5 Ps. Mentioned earlier that my background is in manager research, so I always kind of put myself on the other side of the table here. And with the 5 Ps, philosophy and people, these still matter in this third wave. And I think it's very important to remember as we move on. So second hurdle we have is markets are dynamic. Vinnie spoke a little bit about the history of investing, and I'm sure many of us remember times when the efficacy of a factor could last, 3, 5, maybe even 10 years. But with the evolution of technology and how market structure has evolved, the lifespan of these signals is shortened. And mispricings in the market are often arbitraged away quickly. So just like when we talked about the need to catch credit card fraud in seconds, the need to identify these mispricings quickly and efficiently is vital. And so in this situation, the machine has an advantage. It can act when it sees an opportunity arise without second guessing itself. And so when we view this collaborative alpha approach, we think that a hands-off approach to the stock selection models, once built, is needed. So again, how do you know if somebody is using a hands-off approach? Well, think about how often the humans will override the decisions made by the machine. An ineffective way to use AI in the process is if an investor is leveraging AI scores, but then constantly overriding them or just relying heavily on their own opinions. They're likely, if they're doing this, just reintroducing bias and failing to maximize the skill of the machine learning model. Some of the greatest investment opportunities, I'm sure we're all aware, are in areas that are uncomfortable for us humans to be in, and they maybe not be the most intuitive areas. So naturally, when we see that, we might want to override it, but this defeats the purpose, assuming, going back to step 1, that you've built your features very strongly. So again, kind of just bringing this back to the 5 Ps, think about the people, think about the philosophy that they're trying to build out, and then think about the process. What is the sequence of decisions? And how are the technologies integrated into the overall strategy? And then finally, our third hurdle here is a need for interpretability. This is still very much a people business, even as we enter this third wave. And you and your clients need to be able to understand what is driving a decision and what is driving your returns, most importantly. So a black or an even opaque box is not going to be sufficient. And one way to help overcome this is that you need humans to leverage AI tools and extrapolate this information and be able to communicate it externally. Warren Buffett has said, never invest in what you cannot understand. Again, this still applies today. So thinking about your 5 Ps when looking at a manager, this would relate to performance. I think a red flag for any investment strategy in any of the 3 waves is when a manager can't explain out or underperformance. And just because we're using AI or ML, it doesn't excuse that. On the other side of things, for practitioners or those of you that might be looking to start building these models into your own investment processes, this is also important that for a feedback loop. We constantly want to understand what's driving our models. We're constantly looking for ways to improve them and to increase the prediction accuracy. So this need to create what we call a glass box, not a black box, is very, very important. And so to move on from that, I'm sure you're asking, well, does it work in practice? If I'm getting maybe just 0.5% of alpha, is it worth all this extra work and education that's needed? And we think it 100% is. And we also just want to note that when we talk about collaborative alpha, we're referring to more than just stock selection. We want to use this technology to enhance the entire client experience. And that can be realized in a number of ways. First, we can't overlook the significance of risk management. And machines have a major advantage here in that they make fewer mistakes. And that can go a very, very long way. But we also believe in this concept in the AI world known as human in the loop. And while the machines have an advantage in making fewer mistakes, we need human oversight throughout the whole process. And it's crucial to intervene when necessary, especially to capture events that may or may not be reflected in the data. And this will happen from time to time, usually something more macro related. There can be an outlier geopolitical event, in which case a human might want to step in. A second advantage that we wanted to note was in customization. A focus on customized solutions has been a trend in the industry for quite some time, and rightfully so. I think we all understand that no 2 clients are the same. We don't necessarily want to pigeonhole every client into a standardized approach. So ideally, we can build out a personalized solution for every single client. But we have limitations there on how many different offerings we can actually create. And increasing this customization also just increases the potential for error, which we want to avoid. And this is one area where AI can really shine and help us out. It can help us to offer a myriad of strategies to meet different risks, different return objectives. But you still need that human touch. So think about the softer side of things, communicating with clients and understanding what they need. This is still important for the human to know and then leverage AI to implement. I think we've all probably had experiences where we're calling our cable company or credit card company and screaming customer service into the phone because we have a problem and we need a human to help translate that. That still applies here. And then last and definitely not least is this ability to remove emotion. One of the top ways that any investor destroys value is by irrational behavior. And that can be buying or selling on emotions, not data. As humans in our personal accounts, professional accounts, we are prone to falling in love with a stock, to getting greedy, not knowing when to sell, and to capitulating in the face of underperformance. The machines do not have this baggage, and that can go a very long way in investing. If you think about Warren Buffett, his brain has been compared to a machine. His track record is built on his ability to consume copious amounts of data and make decisions and avoid mistakes. I think there's a reason there's only one Warren Buffett because it's difficult for the average human to do. And leveraging these ML models can help us to get there. And so just a couple examples, I mentioned not capitulating. In terms of customization, another advantage would be to adjust some of the risk return objectives over time if a client's glide path changes. That can be easier to implement through ML rather than doing the paperwork to add or remove a manager to meet different needs. In terms of a human override, I mentioned some of these examples of a human stepping in an issue of solvency or a geopolitical event. And then finally, we just wanted to talk a bit about how at Voya we're doing this every day. We noted this is not a nice to have anymore. We think that it's essential. And over the past 3+ years, we have been building out our equity platform to embrace this concept of collaborative alpha. And this commitment is really reflected in 3 key ways. The first is that we have a machine intelligence team, and these are the architects of our ML models. Currently, they are running 8 fully systematic strategies. 2 of them have live track records that are over 3 years. And then the second is that this is really bleeding throughout our entire equity platform. At Voya, we have fundamental and quantitative teams as well, in addition to our machine intelligence team. And all 3 can leverage the AI models. So the teams across the board are engaging in discussions on thematic positioning, individual stock research, looking to identify outliers in their individual investment universes. And then it's really important to note it's a 2-way street. So our AI team collaborates closely with the fundamental and the quant and taps into their domain expertise in their individual areas to continuously improve our ML models. And we've been building this out for over 3 years, and it's a constant goal of learning about the markets and learning from each other and improving all of the investment processes. And I think this is going to be a huge advantage in 2024 and beyond, just maximizing every skill set that you have for stock selection. And then lastly, I'll admit it's still a little early days here, but we recognize that the insights from our equity models can extend beyond equities and be applied to other asset classes as well. And so this opens up opportunities going forward to collaborate with our fixed income team, with our multi-asset team, and for everyone to really learn from each other with the end goal of generating alpha and creating value for our clients. So I know that's a pretty quick overview. I hope at Voya we're really excited about the future possibilities that AI holds as we continue to incorporate into our platform and across the firm. And before we, ask questions, I think I'll pass it back to Vinnie just for some closing remarks.
Great, thanks, Chrissy. So I think just to sum it up, obviously the idea of collaborative alpha, as you probably gather over the past 25, 30 minutes, for us really is, integrating that human expertise with machine intelligence. It's obviously clear that the AI era is here, but it's not about replacing humans. It's about leveraging machines, and it's about improving risk return outcomes for our clients. So with that, I'm going to pass it back to Hunter to maybe see if there's any questions on the line, and we'd be happy to answer.
Thank you, Vinnie. Thank you, Chrissy. So put your inquisitive caps on and let us know what questions you have. I certainly want to thank Voya Investment Management for, pardon me, for being a diamond level sponsor of the CFA Society. And your very generous support helps us with our mission of upholding the highest ethical and professional standards in the finance industry, as well as advancing diversity, financial literacy, and education across Georgia. So thank you very much, Voya, for your continued support. So to kick us off, Chrissy or Vinnie, why don't you tell us where you get the data for training some of these ML models that you're using? Is it proprietary? Are you going to the broader market? And maybe start us there.
I'll kick off, and Chrissy certainly chime in. So data, like most models, comes from everywhere, right? So whether it's macro or fundamental, some of it's vendor based, some of it's somewhat proprietary, right? And Chrissy mentioned some of the feature sets that have been built, and some of those features are built out of very proprietary data and information that we use in our fundamental process. So I think there's internal, there's external. I think, Chrissy, right now that we're reporting over 10,000 data items per company, or I think that's the number that we talk about. But I don't know if you have any specific examples that we can shed some light on.
No, I think I would just add that we try to use that mosaic theory, and that we're using fundamental data really, we believe, drives returns, and that's the crux of our data sources. But we're also using macro data, technical data, and some alternative data sources, mainly linked to ESG. And we found that those add a lot of value. And a key part of this in when we talk about data is we're using what's publicly available. But a key part is standardizing it across data sources and making it comparable. And that's where a big competitive advantage comes in. I think there's companies you can pay to do that as well. We've built that out internally. And vetting those data sources, scrubbing them, cleaning them for materiality, extremely boring, extremely important.
Very important. Absolutely.
Yeah,
Thank
and
you.
I'll just add one thing, Hunter. I think when it comes to our sort of AI process, Chrissy mentioned this in some of her remarks, but it's not sort of big data, high frequency, right? It's what you would, and it was what you would see in a fundamental equity process. It's sort of the machine is emulating that, and so it uses a lot of the same data as well. So
Absolutely. I know that these are very data hungry applications and systems. Okay, so moving on to questions. Tim Chattard, hopefully I'm pronouncing your name correctly, sir. Under your interpretability hurdle, you mentioned AI can help you communicate your investment rationale. Can you delve into that a little bit?
Yeah, sure. So my role as a client PM is primarily on communication, so this is very important to me. We have a proprietary tool linked to what's known as an XAI technology, where we can dive in and we can see a ranking for any stock in the universe, and we can see what features are driving that rank up or down. And then what can be really interesting is we actually group them or cluster them into fundamentally oriented themes. So we can look at the top 3 to 5 contributors and detractors to performance, and we can write stock commentary by going into this technology. It's web-based, and seeing why did the models rank something high or low, leading to our overweight or our underweight. And so it's essentially like going to an analyst and saying, why did you buy stock A? And the fundamental analyst is going to give their explanation, and it's not going to be linear. It's going to be a bit mosaic. And that is what we see in the models too. So I can look and see what valuation features did they like? Was it in combination with which quality features? Where did the technicals impact this rank? And how did that change from the previous quarter, which impacted our position size? So it's just like talking to a human, although, for the introverts out there, it's even better because you just go to a website. You don't even have to pick up the phone.
Very good. Thank you, Chrissy. Okay. What public tools are available? Some of these obviously are proprietary for Voya. Are there any that you can recommend for some of our charter holders, or what is available out there on the open market that you like?
I think there's a couple ways to answer that. If you're looking for, AI scores, I think there are some software vendors. We like to generate our own proprietary scores. And I noted that Voya, we think that this technology can be leveraged in a number of ways. And what I noted on the slide with the 3 different ways that we're using it outside of just our individual investment strategies, we're always open to partnering with managers and sharing ideas that can help everyone kind of take advantage of these tools. Vinnie, I don't know if you have anything to add to that.
yeah, I think it's the great thing about sort of the early part of this is these tools, new tools are coming online every day. And in fact, the team that we brought in several years ago that was running, they were doing this for about a decade. So they had, they didn't have access to. So one of the questions on here is about sort of access to resources, and they had, they didn't have the scale of access that they have now at Voya, but they were still able to build this out using the tools as they came on. So where you might have sort of big scale tools like a Microsoft Azure or Amazon's web services, for smaller shops, there's a whole bunch of new tools that come online constantly. So I think it's it's in a way very difficult to keep up with the rapid adoption of some of the tools. So plenty out there right now.
Okay, thank you. So let's talk about how these overlays, how this collaborative alpha is doing in real terms of performance. Is there a tilt towards relative outperformance where you're tracking to a benchmark and you're seeing kind of alpha generated there? Is it more from your absolute return strategies? Is there a preference for?
Yeah, there's a lot of ways to use it out there. I think the way we look at sort of the more AI driven active strategies, you could certainly use it at more absolute, but it's high active relative returns. And there's a couple of reasons for that. We talked a little bit about when we talked about the third wave and the ability to combine fundamental and quant. We can go deeper on names, given some of the pattern recognition technology and sort of that nonlinear nature of trying to find stocks using that approach that Chrissy mentioned. So by doing that, versus the old days of sort of quant, when you take sort of very, very small active positions on a lot of names, we have a very strong sort of opinion from the AI models on the names we like. So it gives us the ability to become more sort of high conviction, high active, and I think the removing the human emotion part of that, we like to joke that the machine has no career risk. So it's willing to go to places that, a lot of us really, Chrissy mentioned it, but a lot of us won't want to go to. And I think about positioning post-COVID, where, nobody was ever going to travel again. And, we don't need oil. We're not traveling. We're not moving. And the energy stocks, the position, the machine started leaning in. And, you look at some of the positions, you're like, wow, that, might be early, but certainly there were great opportunities and was able to do pretty well on that. So I think it's high conviction, high active. You're going to have a lot of periods where you have to sort of wait for that performance to come, but machine has time. Chrissy?
No, I think I would agree with that. It's kind of fascinating to watch it. We run it in absolute and relative ways, and it's fascinating to see it gravitate towards those areas that you're hesitant to do as a human. And so that the performance, sometimes it can be a little early. And I always think that that's a good signal to the whole platform of different areas we can think about looking to uncover value. So it works in both the relative and the absolute, but really thrives in high conviction, taking on more risk and being able to take those uncomfortable positions.
Yeah, I'll also add to that. It's a really great point, Chrissy. I think what's happened over the few years that the 3 years that the team has been on board, and we've created some of these models. Our fundamental teams, we have some of the portfolio managers from our AI team involved in our PM meetings, and I can't tell you how many times the fundamental managers are like, well, what's the machine thinking? Where's the machine going? And so that kind of proprietary nature of it, but it tells me that they want to know, even if it's completely opposite from the way they're thinking, and they want to know how the machine's positioned and why. And I think that's what we really want to build on and seize on, because I think that's the opportunity, that kind of non-correlated positioning. So pretty exciting days.
How do you incorporate a machine's tendency for higher turnover? For you mentioned the lack of emotional biases that can affect us sometimes when we're making decisions to maybe loss aversion, or we're holding a losing name, and the machine model would tell you to sell it. When you're taking these larger, higher conviction positions that take a while to establish, but then you've got a kind of a machine that's kind of pushing you for higher turnover, how do you complement the two?
Yeah, I think we certainly in certain strategies have guardrails, right? And so there are limits to what the machine can do. And other strategies, those guardrails are pretty wide, and probably wider than they've ever been on our fundamental strategy. So yeah, it's a range, but there's certainly ways to limit active positions and sector positioning to get it to that sort of right risk level. And most of the strategies, though, we tend to have a pretty high risk tolerance.
Thank you. We have a question from Martin Coughlin. For smaller asset managers without significant data science resources internally, what advice would you give them as they start building out an AI platform?
I think we kind of talked about this a little bit before. I think that there's so many ways to now sort of get access to resources, online, relatively cheap, to get started. I think, obviously trying to get some of the data is important. And, if you're really kind of starting out at that space, I think you've got to, I think, for example, the team that we brought in, when they started out probably 13 years ago, had very little resources, talked to vendors about what they were doing and got vendors to sort of give them sort of the right deal to sort of get involved. But even, listen, there's so much stuff you get Bloomberg access now. You've got a lot of data, right? So I think, if you can get to the data, I think the technology is probably the easier part. Would you agree, Chrissy, on that?
I would agree. And I think I'd also note that there's so many different data sources that exist now. And some of it sounds very exciting when you think about things like using drones and satellite images. And what we've found, though, is our approach is still very fundamentally driven. And we think at the end of the day, adding some of these alternative data sources with very short histories are not necessarily adding more value than traditional fundamental data. So it's important to, again, when we go back to the data, is what is material and what can add value and what is your objective, what is your return horizon, and what are you trying to achieve here? And I think that can help. It can be very overwhelming for anyone when they're starting. Just going back to the fundamentals, because this is still very important to our business.
Yeah, understood. So Faisal Lakhani has asked a question. You were mentioning how in probably mid-2020, the bombed out kind of travel industry was something that was being kind of avoided like the plague, but your models were kind of steering you back towards it. How do you leverage AI for maybe not just sector exposure or pulling you into kind of a space that's being avoided, but how do you leverage it for fair intrinsic value valuations?
It really starts through the feature set that's created for those models and training what we call sort of virtual analysts on those features, using those features. And it's probably less to do with coming up with one specific fair valuation than it is sort of what is the cohort of stocks that the models find have the most predictive value moving forward, right? So it has this, as Chris, you mentioned, there's tons of fundamentals in there. So that you might, the machine may think that, better valuation is going to be sort of where provide the better returns at a certain period of time and lean into those kind of names. And other times where it's leaning into more sort of growthier or even lower quality, more cyclical type names. So it's still that sort of cohort, but it is name by name in terms of how those companies rank within a sector or within a cohort to provide that sort of, I guess, fair valuation or a level, if you will.
Yeah, I just add it's really a bottom-up process where it's targeting stocks, not sectors, and it's going to approach every stock differently. And what the models do, we assign them different time frames or time horizons to look out at, and they're trying to look through different patterns, which will include valuation metrics in combination with other macro fundamental or alternative data points that historically, what is the pattern when I see like a decision tree, when I see this number of features in a name, 9 times out of 10, it outperforms over the next 12 months. That's where the score will get higher and how it determines if the value was worth it or not. So very similar if you think about how a human would evaluate a stock. So it's done in a nonlinear pattern, and it's just looking for pattern recognition that is persistent.
And then I think, Hunter, the point about the energy stocks and travel stocks, that cohort, stock by stock, was looking so attractive. But as Chrissy mentioned, definitely from a bottom up. It was not a top down macro call by any means.
Yeah, makes sense. Leisha has asked, so going back to your human in the loop comment, I guess there's two ways to ask this. Is there a human control bias in place now at Voya that is forcing you to keep humans involved here? Or would you be comfortable letting these systems be completely autonomous? Or is there a human override in the final selection? Where's the give and take, and how much of that is kind of from a control risk perspective and a desire to keep humans involved? And do you have faith that these systems could be autonomous?
Yeah, that is a great question. So in our process, our humans review every trade before it's executed. And they reserve the veto power, but they have historically used it. It's maybe 0.02% of the time. And it's really in an 8 or 9 sigma event. And this goes back to some of the ways that we talked about using the technology in the most efficient way. Often they'll review the trades and they'll think to themselves, I would not buy that, but they don't want to reintroduce that bias. But there have been situations where even midweek, there's a major geopolitical event that the machine just doesn't know. It's not in the data yet. It wasn't in its decision during the last rebalance. And we want that right to be able to go in and exit a name if we think there's maybe a solvency risk or any other major risk that we think would be detrimental to the client portfolio. So I'd say we maintain that human ability to veto for risk management purposes, and aim to not use it and to resist the urge to reintroduce our own biases, and trust the machine. And we're humbled by the machine, I would say, Vinnie, weekly.
Yeah, absolutely. And I'd say also sometimes there's M&A and things that sort of take price to another level where it really doesn't make sense to sort of analyze it in the traditional sense anymore. So corporate actions, you'd see once in a while, things like that as well, but very infrequent.
Okay, well, that's all the questions we have. Thank you so much for your time. Thank you again to Voya for your sponsorship. And please look for a replay of this webinar as well as a survey to follow. And I hope you have a wonderful afternoon. Thank you for joining us.
Thank you all.
Thank you.
Yeah.